Today I'm in a pretty unique spot here that I've never seen or been to in California. It's a little walkway called Veterans Parkway, and as you can see, you have one road on one side of this and one road on the other side. So this whole parkway is smack in between these two major arteries of town, and they have all these little trees and plants and stuff along the way. So I just thought this would be a really cool spot to walk and share with you guys, and once again give you something different. And I also thought it was a good place to talk about more and more people are starting to get denied for all different types of credit applications. And thanks again, Steve, for sending this one to me. This past week, the New York Fed reported that the overall rejection rate for credit applications rose to its highest level that we've seen since 2018. Right now, almost 22% of all applications for any type of credit are being denied right now, which is tremendous considering that just in February the number was 17.3%. So apparently these bank failures and the credit crunch is actually real, and it's having an effect on the economy because the denial rate for loans is starting to go up. And what the New York Fed found, this ranges across all different age ranges and was most prevalent for people that have a 680 credit score or lower. And that's something I'm always telling you guys over and over again, is make sure you pay your bills on time. Make sure you keep a decent credit score, because that's going to come in tremendously handy when you want to get any type of loan. And lo and behold, here we go. 680 is not even that bad, guys, but if you have less than that, you're getting denied, which is even crazier because when you look at the fact that you can have as low as a 580 credit score and get an FHA loan, they'll still approve you to buy a house. That's basically a subprime loan, but yet they'll give people that mortgage right now, which just goes to show you how much shaky ground the housing market could be on. But we're not going to get too much into that in today's video. Just wanted to make that quick point. And if you look at this graph, you can see there's a huge spike in the amount of denied credit applications, so much so that it's already nearing the point where it was back in 2013, which was the height of credit denials back after the Great Recession. Okay, this is when so many banks didn't want to give a loan to anybody because of all the financial fallout we had back then, and we're already approaching levels that we haven't seen since then. So what does that tell you about the economy we're in right now, especially since we haven't officially had a recession, right? There's been no recession, at least according to the officials, and there's been no real fallout. There's been no real crash of anything. We haven't seen a stock market crash. We haven't seen a real estate crash. So what is going on? How are we seeing credit tightening up this much in an environment like this? Well, it's because banks are failing, and there's probably going to be more banks that are going to fail due to the high interest rates that the Fed has been keeping, as well as the fact that because they have high interest rates, these banks are really hesitant to lend out more money right now because they are trying to just make sure they stay in business. And every loan that they give out at the moment is extremely risky from the standpoint of, are we going to be able to pay our own bills? Now check this out. Auto loans are getting rejected at a rate of about 14.2% right now, which is up from 9.1% in February. What is going on, guys? I thought everything was supposed to be good right now. I thought people were making all this money and, affording these $1,000 a month car payments. People are doing great. And guess what? This denial rate for auto loans is literally the highest level we've seen since 2013. And go back and reference that graph I showed you a couple of minutes ago, and that's when we had the highest amount of credit application denials since the last Great Recession, okay? But it's happening right now, these credit denials, not after a recession. This is even before the recession. What's it going to look like afterwards or during the recession? Credit card applications are being denied at a 21.5% rate right now. Credit limit increases are being denied at a 30% rate, almost 31%. New mortgage applications are being denied at only 13.2%. So you can see just by that how much housing is being propped up by them giving practically anybody a loan, guys. If you have decent credit, maybe you don't even have decent credit, if you're getting an FHA loan, you can still buy a house with a practically nothing down payment if you're going to go with FHA or Rocket Mortgage with their 1% down payment or whatever latest housing scheme they've come up with. But the request for refinancing has been getting denied at a higher rate at 20.8%. So mainly they're approving new people to get in and buy homes right now more than anything else, but all other types of credit applications, the major ones, are being denied at a significant rate. And you know what's interesting about all of this is the actual amount of applications that are being submitted for all these loans is actually on the downward slide. In fact, you have the total amount of people applying for credit declined from 40.9% to 40.3% as of February, okay? But at the same time, even though credit applications are lower than they've been in a couple of years, the amount of them that are getting denied is spiking. That's not exactly a good omen for where things are headed, because in case you don't know, this entire economy is built on a huge debt bubble. And the only way to keep the magic show running is for people to continue taking on more debt. That's how money is created in this economy, where they print money out of thin air. If you don't take on debt, they can't print money. Taking on debt is printing money, okay? This is something that people need to understand. And as that slows down, this brings the economy to a grinding halt. So much so that this is likely going to be where the actual recession is going to come from. Because as it turns out, a leading indicator for recessions is the amount of auto loan approvals versus rejections. And rejections in auto loans are now at all-time highs and are exceeding the amount of new applications. So more people are getting denied right now than people who are getting approved. If that's an indicator of a recession, then we're pretty much marching right into one right now. And even the economists are confused, guys, and so am I. Like, probably everybody who's watching this is confused on where things are gonna go. Because even though this can be an indicator that we are going to head into a recession sooner than later, it's not a promise or a guarantee. And there's been so many curveballs ever since the pandemic that I don't think anybody really knows where things are going to turn next. And because the default rates for all different types of loans are also on the rise, that's another reason that credit is getting harder to acquire right now, because you have banks pretty much upping their loan loss reserves by more than $25 billion just since June last year. So these are all the amounts of defaults that they're expecting, okay? They're expecting people to default on so much money that they're setting aside an additional $25 billion right now because they think people aren't going to be paying their bills. So if I were you, I'd be looking at all of these credit application denials and the amount of money that banks are saving up for people to default because they know it's coming as your early warning sign to be prepared, guys. You know, the worst thing that can happen when you're preparing for an economic downturn is you end up with extra money in the bank, you end up with less debt, maybe no debt, and you know, you're in a better financial position in a few years from now than you started off as. So I don't see how there's anything bad about preparing for this. And if some miracle does come true and we dodge this entire recession and there isn't one at all and everything is just perfect, then what's the worst that happened? Nothing. You're in a better financial position now. Now, for all of my Florida friends that are thinking about buying a house, you need to be extra careful right now, because one of the biggest concerns about buying right now is how much is it going to cost to get insurance, okay? Do you even know? If you're looking at buying any potential property, do you know how much it's going to cost you for your yearly homeowners insurance premium? Or better yet, do you know if you can even get coverage? Because there are so few companies writing policies in Florida now, combined with the fact that how much they are charging, it is getting obscene to the point where people cannot afford insurance, or they might not even be able to get coverage. And right now, the standard advice is in Florida that if you're buying a house and you're estimating that you're going to be paying $150 a month in homeowners insurance premiums, you might as well up that to $400, guys. That's about $4,800 a year, which is pretty much the average that most new Florida homeowners are paying right now. And it can obviously go a lot higher than that. And of course, there are some circumstances where people pay less than that, but that's just the average now. You're talking practically $5,000 a year just for homeowners insurance. And the problem is many home buyers do not think about this and do not factor this in to their monthly budget when they're looking at buying a home. This is yet another thing that can impact people tremendously after they already buy the house and they're already stretching themselves thin with these extremely high debt to income ratios, and now wham, you get hit with a property tax increase for the next year because you bought a house and you thought the taxes were going to stay the same, and oh, the homeowners insurance went up 20%. This is happening to people. Now my question is, what is this going to do to future home prices in Florida? Because right now, Florida is still pretty much on fire throughout most of the state. Not everywhere. There are places that are on the decline now, but for the most part, the entire state is still seeing big gains in home appreciation. So I wonder, at what point is it going to be that people are going to start feeling this as a real problem, and it might start reversing the price trends in Florida, and when it's going to make people stop and think, even if they can afford it, if they should even be buying a property there, because how much longer are you going to be able to get insurance for? And if you can, how much is it going to cost in the future? And the other problem with so many insurance issues going on in the state is that eventually, if enough insurance companies leave the state, this could ultimately start affect people's ability to even get a mortgage on a property in the future. And I think if that happens, then we're definitely going to see Florida home prices take a hit for sure. But the Florida state legislature did pass legislation earlier this year that's aimed at bringing more insurance companies back into the state. And we've yet to see the real results from that, and if this is really going to happen and if it's going to work. But hopefully another year or two from now, we're actually going to start seeing some progress with this and start seeing more insurance companies come back. But the thing is, if we get smacked with another hurricane here in 2023, you think that's going to be an incentive for insurance companies to come back? Probably not. And guess what, guys? If you get hit with these insurance increases, what can you do? Well, practically nothing. Of course, you can shop around and you can try to find a better deal, but that's becoming almost impossible for most people. And chances are, if it went up too much, then you're going to be another statistic and you'll end up on what's called Citizens Insurance, which is the state-run insurance company. And even to get on Citizens, they might not even accept you unless you're willing to make repairs to your house. They might require you to get a new roof. That's one of the big things with insurance right now. If you have a roof that's more than 10, 15 years old, no insurance company will write a new policy on your house, including Citizens. So that can be a big expense that people are going to have to foot the bill for. They might require you to do wind mitigation tests. They might require you to do some retrofitting to make sure that your house can survive a hurricane. They might require you to chop down some old trees in the backyard. Lots of different things that can end up costing a lot of money. Word to the wise, and a warning for anybody who's thinking about buying in Florida this year or next year even, that you need to be looking out for how much is your insurance going to cost. Can you afford it? Will you continue to be able to obtain coverage? Because, we just saw last week, Farmers Insurance pulled out of Florida. And if I were a home buyer in Florida right now, this is what I would tell you guys. I would tell you that right after you go under contract on the house, then the number one thing you need to do, or actually two things you need to do ASAP, as soon as the ink is dry, is you need to get an inspection set up on that house. I don't care if it's even a brand new house, get the inspection done. And at the same time, contact insurance companies. Find out if you can get coverage. If you can, how much is it going to cost? What is covered? How much is included? Do you need flood insurance? All this stuff. And make that part of your due diligence process when you're buying a house, because it's becoming such a problem that you don't want to get blindsided with this afterwards once you own the home and get slapped with some tremendous increase that you weren't going to be aware of because you didn't do this simple step. Because when you're in the beginning phase under contract on a property, as long as you have an as-is contract, guys, you can pull out of that contract for any reason you feel like during your due diligence period. So if you get 7 or 10 days, use that time frame to pull these insurance quotes and find out how much it's going to cost. Get that inspection done. Make sure there's no major problems with the house. And if everything checks out and you can get a reasonable insurance rate, then go ahead, move forward with it. But just make sure you follow these simple steps so you don't get burned. And guess what, guys? The increase in insurance is not the only unexpected expenses you can be hit with as a new homeowner. No, 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 no. There are many other things that can happen as well. And a young couple that bought a house, actually a townhouse, last July in Cincinnati, Ohio, found this out the hard way, okay? They closed on the house in July 2022, and August of 2022, the wife gets laid off. Bang. Lost one income, overnight. Well, luckily, they didn't have to take out loans. They had an emergency fund saved up, and they were able to make the September mortgage payment out of the emergency fund. And they also had a few extra months of mortgage payments saved up that they could pay out of that emergency fund. So it wasn't like they were just screwed overnight. So at least this couple was somewhat prepared when they bought the house. But even though they had money for the emergency fund to make the mortgage payments, one thing that they were not anticipating is all the extra money they would spend on moving into the house and sprucing the place up and making it a home, so to speak, and different little repairs and things that they had to do to make sure the house was a nice place to live, right? And it turns out, just in that first year, they spent an additional $6,600 in addition to mortgage payments, insurance, taxes, and all those things, okay? So talk about unexpected expenses, guys. $6,600 a year. Can you afford that? Can you afford to spend an extra $7,000 when you move into the house after you just put your down payment, after your closing costs, after all of that fun stuff that it costs to buy a house? Can you afford that? I want you to ask yourself this if you're somebody looking to buy right now at these prices and rates, because I think a lot of people can't. In order for people to get qualified at these rates and prices right now, people need to be stretching their budgets to the absolute limit and their debt to income ratios to the absolute limit. So there's almost no room for error for a lot of people, and that's why I'm bringing this up. Just the move-in costs alone for this couple cost them almost $3,000 just to, put gas in all the cars and the U-Haul trucks. Think about all the supplies you need, boxes, tape, everything that goes along with moving, the actual rental costs to rent the U-Haul trucks, and they didn't even hire movers and it still cost $3,000. But they had to buy other things like a couch, TV stand, a washer and dryer that didn't come with the house. That was an extra $1,200. Different utensils and things for the kitchen, extra $200. So it all adds up. And these are things that a lot of people probably don't think about when they're going to be buying a house. Even me, even though I was renting before I moved into my new place and I had pretty much everything we needed, okay, well, we moved into a bigger place, so we needed a few additional pieces of furniture. And, of course, women being the way they are, my wife wanted to buy some extra things to make it a home, and that's fine. But guess what, guys? All that stuff costs extra money. And these are things that people don't anticipate when they're buying a home. But the real big mistake that this couple made is they had no idea that their mortgage payment didn't include their monthly HOA fee at their townhouse. So their monthly HOA fee there is about $225 a month. They didn't pay it for an entire year, and they got super lucky because their HOA apparently doesn't charge late fees on unpaid HOA dues. They got charged no interest, no late fees, which is a huge miracle because that would never happen in Florida, pretty much anywhere. They're lucky they're in Cincinnati for sure. So they also had to pay an extra $2,500 just for that because they didn't pay those HOA dues for a year. And on top of all this, their HOA fees is going to go up to $300 starting at the beginning of next year, as HOA fees always do. And on top of that, they're going to be getting a special assessment. So more unexpected expenses that this couple is going to have to pay for. Now, luckily, they've been able to be resilient throughout all of it. The wife ended up getting another job, and basically the one thing that they said that they will do different next time is to have an even larger emergency fund saved up because it just wasn't enough. Here's a statistic for you to remember. The average homeowner spends about $6,300 per year on unexpected expenses, guys. Whether it be that new sofa, whether it be a dishwasher that breaks, an AC unit that breaks, doesn't really matter what it is. There's always going to be something when you own a house. And the point is, you need to be ready to spend that extra money because it's not a matter of if, it's just when and on what. And not only just being prepared for unexpected expenses on your home, but just being prepared for this recession, guys. Many economists think that we are still going to see a recession, and now the time frame has changed, and they're predicting it's probably going to be towards the middle of 2024 when we're most likely to enter an official recession, right? But if you're like me and you've been preparing for one for over a year now, and you'll be fine, okay? Chances are you'll come out this thing on the right side because there's still many things working against us right now and why they believe we're gonna have this recession, We're still gonna have more interest rate hikes by the Fed this year. There's a slowing business investment right now. There's a depressed housing market. Things have been coming to a practical standstill when it comes to real estate transactions and volume. You have ongoing strains and concerns with the banks when it comes to lending, like we talked about earlier. So just get ready now. The more prepared you are for a recession, the more prepared you are for unexpected expenses, no matter what they might be, the better off you'll be. If you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.